Welcome to Alpha Insights. I'm Adam. Today we're talking about Caterpillar's latest dividend decision with my friend and market watcher, Matt. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Adam. Great to be here.
So Matt, quick headline. Caterpillar's board decided to keep the quarterly dividend where it is. But the real question here is, what does that actually mean for investors?
Right. At the simplest level, the company kept the payout steady at $1.51 per share. The company set a record date of April 20th, 2026 to determine who gets it, and the cash will be paid on May 19th, 2026.
Okay, so stability, not a surprise raise. How should people think about that?
When you look at the data, this signals the board thinks cash generation and capital needs are balanced for now. Analysts note that keeping the dividend steady suggests they don't want to stretch the payout, given cyclical risk in construction and mining demand.
Interesting.
For income-focused portfolios, that predictability matters. If you rely on regular distributions, maintaining the payout preserves expected cash flow. But for growth-oriented investors, it doesn't signal extra capital returns or a ramp-up in buybacks.
Yeah, that's a good point.
And traders will watch the ex-dividend dynamics around the record date. There can be short-term price moves when a stock goes ex-dividend, because the price typically adjusts to reflect the payout. That creates some tactical volatility, not a change in the company's long-term story.
Let's get into the risks. What could make this dividend change in the future?
A few things. First, economic cyclicality. If construction or mining activity slows meaningfully, equipment orders and cash flow can weaken, which would put pressure on future dividends. Second, capital allocation trade-offs. Management might prioritize debt repayment, reinvestment, or share buybacks instead of raising the payout. And finally, dividend policy changes. The board can revisit the payout if cash flow or strategic needs shift.
That's an important caution.
Honestly, I was a bit surprised by this one. Not because keeping a dividend is unusual, but because when markets are watching cyclical demand, any change or lack of change can be a signal. Here, the signal is stability rather than an aggressive push to return more cash to shareholders. For investors who want to monitor how sustainable this payout is, track upcoming earnings and free cash flow updates. Also watch industry indicators, construction starts, commodity demand, and equipment orders, because those drive Caterpillar's top line and cash generation.
So actionable monitoring rather than immediate action. Got it. Quick reminder for listeners.
Just a quick reminder, we're sharing information and analysis, not personalized advice. Analysts' note and data suggest certain outcomes, but this is for informational purposes only and not a recommendation to buy, sell, or hold any security.
Perfect. Before we wrap, give listeners 2 or 3 key takeaways they can remember.
Sure. 1. Caterpillar maintained its quarterly dividend at $1.51 per share, with eligibility set on April 20th, 2026, and payment on May 19th, 2026. 2. The decision signals financial stability, but not an increased cash return program. 3. Keep an eye on earnings, free cash flow, and industry demand indicators to assess dividend sustainability.
Nice and tidy. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai.